Hello traders and welcome to the whale trade strategy. In this video we're going to go ahead and talk about volatility from just a larger concept, but then we're going to really start to dive into the strategy, have multiple examples for you here as well. Even going to talk about how to set the tool up for you, so it's going to be really interesting and I'm sure you're going to get a lot out of this video. But first I must remind you that trading does carry significant risk, and all information in this video is provided for educational purposes only and does not offer or recommendation to trade futures, stocks, options, or forex. Alright, let's go ahead and talk about the whale trade. Well, first of all, it is a strategy that you can use to find high probability, very large tick winners on a monthly basis in the futures market. It's based off of our volatility tools and is very fine-tuned to identify very specific conditions in the market that have the potential for monster moves. As a result of this, you typically will only see this tool trigger one trade in a market on a monthly basis. So this is not a daily strategy. Now, this tool is customizable, so you can trigger more signals if you wanted to tweak the tool. You can put those functions in. The tool right out of the box is perfectly tuned and ready to go to find these monster trades. But again, you want to scan these on each market on a daily basis to make sure you're not missing a trade. So you'll only get one trade per market per month, but in a month you may have 3 or 4 trades, maybe 5 trades on a good month, depending on the markets that you're looking at. But those trades will be typically triggered on a 240-minute, a higher time frame chart, and then you'll go ahead and hold those trades for the next few days until whatever the targets that we have pre-built into the tool itself, they get triggered, or one of your own targets go ahead and gets triggered. So you most likely will be in one of those trades for a few days. So something to keep in mind. It will be a swing trading type of strategy. So before we get into that, let's go ahead and just talk about volatility from a higher standpoint. So just a larger picture. So we're going to answer these questions. What is volatility? And then most importantly, how can we use the whale trade strategy to go ahead and profit from knowing what volatility environment that market is in? So let's go ahead and start with the first question here, defining volatility. Well, volatility is a measure for variation of price of a financial instrument over time. Historic volatility is derived from time series of past market prices. So typically what this means is that you will have the market, maybe in a very low volatile environment, and you see small moves, maybe something like this going on in the market. And if historical volatility is something that low, and then all of a sudden you have the market really explode and give you markets like these, when you look at historical volatility in comparison, these are very volatile markets. When you see price movements really screaming from high to low in a quick fashion, but instead of trading between $5 and $10, now they're trading between $20 and $1. You see these big wide swings in price. That is volatility. So it's that variation of price. Now, volatility can be further defined as a statistical measure of the dispersion of returns for a given security or market index. Volatility can either be measured by using the standard deviation or variance between returns from that same security or market index. Commonly, the higher the volatility, the riskier the security. So if you trade stocks, for instance, and you see that typically you have a 2% return on it, but now you're seeing 3, 4, 5% returns. Well, the volatility is certainly higher, but the flip side of that, you are making more money in that. It is increasing a percentage quicker and faster, but the downside of that, or the flip side of that, is it is a riskier security. So that's always something that you want to go ahead and keep in mind. Volatility is great as far as the day trader. Day traders love volatility because the market just moves so quickly. As a swing trader, though, you can look at volatility as giving you a way to maybe enter a market without chasing. So for instance, if you have the market that really moves and is, it's something like this. All right, the market's kind of moving slowly. All of a sudden you have these big breakouts in volatility. Instead of chasing price all the way up here, you can go, because you have volatility, you just have to be patient and kind of sit in your hands and wait for price to pull back and then give you an opportunity to go ahead and enter this trade. At that point, and then typically with volatility, the market should start spiking back in the other way in a violent fashion or a quick fashion, and then you're in a good position. You have a good trade working with you. So volatility is a double-edged sword. You will have higher returns. You also may have steeper drawdowns if you don't handle that volatility better. So typically as a trader, when the market gets a little bit more volatile, you want to be, you don't want to hesitate. You want to go ahead and take those entries when you see them, but you also want to sit in your hands a little bit more and kind of let the market come to you if you miss a trade. You never want to chase a trade, because typically what happens in a volatile market is traders will go ahead and chase a trade, buy the breakout up here, experience drawdown, and the market could certainly come back up and make higher highs here at this point, but they have to deal with all this drawdown, which mentally is very difficult to deal with. And if you're not really a strong risk manager, you could experience some drawdown. It could really affect your account and maybe affect some positions and affect your cost basis here. So a lot of things you want to consider here. Again, volatility can be your friend or it can be your enemy. So some of the things to consider when defining volatility in the market. This is the most popular way, the popular definition when you're measuring fear or volatility, is that it is the defined way to measure fear and greed. So you may be familiar with the VIX index. VIX, there's other ETFs out there, but that is a measure of fear in the market. Typically when you see the VIX start to spike, typically you'll see the VIX for a long time is doing something like this. Very small moves to the downside. But then all of a sudden you see some type of news item hits the market, rate hikes, for instance. Rate hikes are coming back in. Maybe liquidity is kind of coming out of the market here at this point. Some type of fear comes into the market, war, some type of terrorist attack. All of a sudden you're going to see this VIX, start to do something like this, right? Start to spike. Right? It's a lot of fear coming into the market, but at the same time you're seeing in futures markets or stocks or anything else, is you're starting to see big wild swings and moves. So that VIX index is measuring that fear, the amount of volatility coming into the market as people are repositioning, or maybe they're chasing prices, paying a little bit more for their positions than they'd like to. Are selling their positions at a worse price than they'd expect. Whatever the case may be, it is a it is a way to measure fear. So when you see that volatility start to spike, the market is really coming into some fear here in the market. Sometimes when you see it start to slow down, like we had here for quite a long time, it could also be used as a measure of greed in the markets, as people are pretty content in their positions, just kind of letting profits run. So let's go ahead and talk about the low volatility versus high volatility environments. And we were kind of touching on that here a second ago, but a low volatility environment, you can play with larger size, you can lower your risk, and it's a really good environment for swing and position trading. Not so much for day trading, because again, in low volatility environment, whether it's a stock or anything else, you're having these small moves up and down. As a day trader, you have to play a little bit more size, but typically they like to go ahead when the market starts moving higher. They want to go ahead and fade it, or maybe they're momentum traders. They want to play breakouts, for instance. So in a low volatility environment, breakouts are not a good strategy. You want to go ahead and either get with the trend, or if you do see a spike in the day and you want to go ahead and try and fade that, but typically you'll see a spike and then the market will kind of calm down. So it doesn't mean that there won't be, for a day trader, there won't be volatility in the market. So let's say around 10 a.m. Eastern time, you have a news item that typically comes out around that time, and it really spikes the market at that point. You're in a low volatility environment, but you see a spike in that market. Well, that's a volatile period for about 5 to 10 minutes, but then it'll tend to retreat back to a low volatility environment as the market digests that news and moves on. So in this case, in the news, trading around news is probably better for day traders since they get that little spike of volatility. But for the most part, swing position trading, carrying positions over a couple days, slowly making profits as the market kind of grinds along. You can lower your risk because the market isn't spiking around, isn't going crazy like this. You can go ahead and lower your risk. You can put stops here. You can follow your stops up here. Pretty much lower your risk. You can also play larger size because the market isn't moving in that quick fashion. So again, pretty ideal for swing or position trading. Now, a high volatility environment, you need to use smaller size. You need to reduce your risk. And the reason for that is that you have these big wild swings in the market, you have a higher chance of being stopped out. Now, if the liquidity is kind of coming out of the market here at this point, then you could get slippage on price. Price could go a little bit further than you'd expect. You could be right and wrong at the same time. So let's say that the market is kind of doing something like this. You have an order parked up here, and the market spikes, hits your order, moves up a little bit more, and starts to turn back over here. All right, this is classic volatility here, where people start getting upset and they get stopped out. Hits their order, has some slippage there, moves past their order there a little bit, probably gets top ticked or stopped out, right about there, and the move starts moving in the stock or ETF or futures contract starts moving in their intended direction here. So you're right as far as direction, you're wrong as far as entry or maybe even risk. Maybe you should put your stop a little bit further away. But these are some of the things that come with high volatility environments. So you want to use smaller size because there's a higher chance of being stopped out. There's a higher risk at that point. Even though you're using smaller size, there's a higher risk of being stopped out just because, the slippage, the lack of liquidity to kind of protect that market as the market moves through it. So a lot of things to consider there. Again, ideal for scalp trading. If you are a scalper, a high volatility market, scalper or day trader, a high volatility environment is ideal. Those are the markets that you really want to take advantage of because price is really moving. You can play smaller size on those. You can be in and out of your trades within the day instead of carrying positions into the next day. So these are great environments for scalp traders or day traders alike. Typically you'll have, for a long time you had a low volatility environment, and then you can transition to a high volatility environment. If there's a lot of news, especially in a bear market, you'll see high volatility environments pop up quite often. Bull markets, you will tend to see some high volatility in there as well, but typically will kind of level off and go into a low volatility environment on average, I should say. So we kind of talked about that from an abstract standpoint, a kind of a higher view of volatility. But let's go ahead and actually, apply it here and take a look at the chart. So here we have the 6J. This is a 240-minute time frame. And this is a great example of what low volatility versus high volatility looks like. So right away from the chart, without even doing any chart work or anything at all, if you were to identify what's low volatility and what's high volatility on the market, you could almost draw a line right down the middle of this chart, something like that, and identify this side here, all right, this side here as a low volatility environment, and then obviously this side would be a high volatility environment. And so why is that, right? We're not looking at any numbers here. We're not looking at statistics or any standard deviation or anything like that. We're just looking at it from a visual sense. Look at the price action here. You see some wicks through here, but look at the size of these bars. For the most part, it's in a downtrend. You have these bigger bars, something like this. There's another bigger bar here. Another bigger bar here. All right, but I can pretty much point them out. We have 1, 2, 3, 4, let's say 5, 6, 7, 8 big bars in this big downtrend here, 9 right here. But on average, for the most part, you have all these little tiny small bars here. Look at this. Almost no volatility there. All right, when the market is moving in an orderly fashion, it'll typically be low volatility, and you'll see things like this. You see a beautiful bear flag right here. This is why continuation traders or trend traders, they love bear flags or bull flags. This is a perfect one here. All right, you see that consolidating in the bear flag, bam, breakout. It's consolidating in a bear flag, and then you have it's kind of a so-so breakout here, but a lot of low volatility, a lot of small and tiny candles here. Okay, so again, trend followers love this. Easy to manage a position because as a position moves in your favor, just stair step your stop loss as it just move it down. You see a little correction, move down, move your stop loss, correction, move down, stop loss, so on and so forth. Now you get a little bit more volatility coming into here, but when you typically have bottoms or tops being put into the market, you'll start to see a little bit more volatility start to pick up. You'll see maybe bigger moves or exhaustive type moves. An exhaustive type move would be a spike similar to what you see here towards a low, and then you'll see a move kind of off that here fairly quickly. I didn't get that here, but you see the bears are still in control of this market. Take that off here. But as we get towards the bottom here, you start to see again this trend is starting to steepen here a little bit of low volatility here. But this is the exact exhaustive action that you like to see. All right, you have some pretty good moves here. Then all of a sudden you see pretty low volatility. Then all of a sudden a spike to the downside, and it starts to spike right back into the opposite direction here. This is more of an exhaustive type setup here. Now we're transitioning from low volatility into high volatility. And take a look at all the big bars here. All right, you got 1, 2 there, 3. I got 4 here, 5, 6, 7, 8, 9, 10. Let's see, another one, 11, 12. Here's another 13, 14, 15, 16, 17, 18, 19, 20. Yeah, you have quite a few big bars here. Look at the size of these bars compared to this, right? All these wicky low, the open here, close up pretty much in the same spot. But you see the open here, close all the way up here. Even these bars that are kind of corrective. Look at the volatility. Look how these bars right here in the middle, while they're a little bit choppy, a little bit more corrective, you can clearly see the difference of volatility from here to the volatility from right here. Small, tiny bars, big, large bars. And you see this, the volatility really start to pick up. Now, from this downtrend, recoups maybe about 80% of that fall right here in this move, fairly within a month. This took about a little over a month to complete. This took about half a month to go ahead and recoup. This is high volatility. Just visually looking at a chart, you can see this right away. Here's another example of high volatility versus low volatility. And you can see and this is crude oil, again, on a 240-minute time frame. And you can see all these little small bars right through here. Now we had a little spike there, but then it goes, this again, a low volatility environment, then it goes right back into these small gains. Right, we're in an uptrend, but you can see very choppy. You get another big spike here, but then very choppy here again, and then one final exhaustive spike there, and then quick reversal here. And then right away you can see just in this area here, we had a couple big spikes, but this is a low volatility environment. This little move to the downside starts turning into high volatility. Now, typically in a bear market, you will see high volatility, and in a bull market, you'll see low volatility on average. But you see that we get some big bars going through here, moves to the downside fairly quickly. And you can just look at the time here. So this starts on September 5th, and it moves down probably about 50% of this move to the upside in about 5 days. To take, from the lows all the way to the high took, let's see, almost about 15 days to go ahead and move up. And then to take all that back took 5 days. So 15, that's typical in a low volatility environment. 5 days to go ahead and take all that back in a high volatility environment is pretty typical as well. So you get a little bit of high volatility through here, then all of a sudden it goes back into low volatility. All these little small bars through here. Again, great for swing trading, great for stair stepping up your stop loss. And then all of a sudden we get towards the top, and you'd expect, again, low volatility here. And then every time there's a top or bottom putting in, most times, you'll turn into high volatility as there's repositioning going on here in the market. So you see these big spikes here, another one here, spikes to the downside here, and you start to see this market really start to move off. This is a high volatility environment, actually from here all the way down. You can see these big bars really starting to take price to the downside here in an aggressive manner. Here's another example of the ES. Now this is a great contrast. This entire move to the downside here, right? This is high volatility environment. You see big, quick moves to the downside, big bars. This starts here in December, let's say 5th or so, 3rd or 5th, and then it ends down here on December 23rd. So pretty much for the month of December, just big volatile moves to the downside here. And then we transition from a high volatility into a low volatility environment. Look at the size of these bars from all the way here, all the way up from December 30th, all the way for the month of January, pretty much just slow, steady gains. All these little tiny bars here, just slow, steady gains. Again, when you're looking at a bull market, you typically see this kind of action. In a bear market, this is that kind of action that you see a lot of panic, a lot of greed, a lot of panic and fear. And in a low volatility environment, you definitely see these small candles here as trade starts to make higher highs and higher lows. Again, a great contrast between high volatility and low volatility. One thing that you should certainly pick up on as we're going through some of these examples is that when you have low volatility and the market really contracts, it will typically expand from that contraction. It can only stay contracted for so long until the top kind of blows off and then you get this high volatility environment. So when you have expansion, typically you'll have contraction after that. And when you have contraction in a low volatility, it typically go to expansion in a high volatility environment. And that's where the whale trade strategy really shines. It is looking for those low volatility, those really tight markets, and it's looking for those conditions where an explosion could happen from low vol to high vol. And that is something we need to monitor. So let's go ahead and talk about the whale trade. Now, this tool identifies when volatility starts contracting, but also watches multiple time frames moving average. So it follows that this is a trend following type of strategy that makes sure that you're trading in the same direction of all those moving averages. So again, we are looking at time frame moving averages from 15 minutes to all the way through to daily, and combining all of those to make sure that you're trading in the correct direction, that you're following the trend. And you're not just following the trend, you're looking for little contractions within that trend, and you're going to be looking for the conditions for a breakout. So just to give you an example, we were talking about bull flags and bear flags in a low vol environment. Well, for the whale trade, what they're looking is something similar to that. So you see a move up, and then you see a contraction here. All right, you see really a contraction in price. You had an expansion in price, again, high vol. All right, then we go into a low volatility environment, and then the whale trade, the tool is looking for this type of environment, looking for breakouts. And then once you get your breakout here, we're back into a high volatility environment. Then you're already long from down here, and you're into a good trade. So again, we are looking for that volatility really start contracting, but we also want to put a layer on that of looking at the time frames, the multiple time frames moving averages to make sure that we are trading in the direction of the trend. We want to go with the stream. We don't want to fight against the stream. So this tool is customizable to any type of volatility environment, whether they are low volatility or high volatility. So you can also choose the type of moving average you'd like to utilize. So this tool, again, very customizable. It is typically out of the box based on an EMA, but you can go ahead and change that to a simple moving averages or double moving average, whatever the case you'd like to, whatever kind of moving average you like to utilize. I know a lot of traders will typically have their own kind of moving average and their own setup. You can go ahead and try and plug it in to see if it works well with the tool. But again, out of the box, this whale trade specifically tuned to find these trades, so I wouldn't really mess with that too much. But again, it's up to you. If you want to customize it and change the moving average to kind of filter out your trades, you could certainly go ahead and do that. A very customizable tool. All right, typically when price action contracts into this tight market, it'll eventually explode and expand rapidly, which is tool specifically designed to identify and help you capture. So a lot of people will typically look for, the bear flags or bull flags on the chart just using price action. They could be fairly effective using that here as well. But this tool is going to, there's a lot of guesswork that goes into that, and this tool is really going to take all that guesswork out of it for you and use algorithms and formulas to find where the market's truly contracting, that volatility of volume is really starting to come out, and then we'll look for the conditions where it can really explode and expand, and then just show those very clearly for you right there on the chart. So now let's go ahead and transition. This is the part you've been waiting for. Let's go ahead and get into the meat of it and talk about the whale trade strategy. We talked about volatility, the different environments, so give you an idea of what to look for and what to kind of stay away from. But let's go ahead and actually talk about the implementation of the whale trade strategy. So first of all, what you want to do is go ahead and open a 240-minute chart. You want to install and or load the tool onto the chart. So if you already have it installed, go ahead and load it onto the chart. In this video, towards the end, we're going to go ahead and talk about how to set that tool up. So if you haven't done that yet, we'll get to that here towards the end. But go ahead and load the tool on there. You want to place this tool in multiple markets such as the ES, the NQ, the YM, crude oil, the 6E, and then scan them daily for possible setups. Now, this trading strategy will identify on average one trade per market per month. So if we were to look at just the average, just on the markets that we stated here, that would be 5 trades per month that you would get out of this tool. Now, if the market is more volatile than normal or than average, then you should get more signals actually populating there as the market will be volatile, contract for a little bit, and then be volatile, and then break out again. Some months, you may actually get more trades just because the volatility is higher. And then on some months, you may actually get, maybe say 3 trades because the volatility is lower and the market's not really, it's kind of a tight market. So you're not really seeing a whole lot of breakouts there. But this is one of those strategies that you can go ahead and put in your back pocket. This is not something that you're going to see on a day-to-day basis where you can go ahead and create an entire system around to, again, trade daily. This is going to be one of those things you can have in your back pocket. So you're going to do your setups and trade the way you trade on using whatever volatility strategies that you have, whatever other strategy that you want to trade with. But then this one's going to be in your back pocket, so you're going to be watching this on a day-to-day basis. And then once a trade triggers, you're going to go ahead and place that trade. And a trade from the whale trade strategy could make your week, could make your month with some of the monster moves that really come out of it. So again, this is kind of a supplement to what you're already doing. Now, what you want to do next is wait for the tool to identify. It's going to draw this volatility box, and then you're going to just wait for that box to complete. A signal bar will then be created once price is broken above or below the completed box. Now, again, it takes the guesswork out of it. You're not looking for price. You don't have to watch it. There's alerts built into it as well, and but you don't have to guess which bar is a signal bar. It'll actually paint the bar for you, so it's unmistakable that when that bar breaks above that box or below that box, it's going to go ahead and paint that bar a specific color, and you'll know right away that's a signal bar. Once you see that, execute a position once a signal bar has completed, and then place your stop at the opposite end of the volatility box. Now, a lot of people, when they see the profits and kind of trades they can make off this system, are very eager to go ahead and jump into a trade as soon as they see price start to move below, but they don't wait for the price to go ahead and close. Now, if you're an aggressive trader and you simply can't wait, or you just you have so much confidence into the trade, you can go ahead and enter that trade if you like. But typically we recommend go ahead and wait for that bar to close, and then if it closes positively and it closes above or below that box and it gives you that signal bar, then go ahead and place your trade at that point. Wait for that bar to close. There's sometimes you could get positioned a little bit better. Sometimes there's a little bit of a fake out. It is higher volatility that we're trying to capture here. So that's something to consider there as well. If you're an aggressive trader, again, go ahead and enter that trade as the bar is being formed, but typically we do recommend wait for that bar to sit in your hands. Wait for the alert, the alarm, however you have it set up. Wait for that bar to go ahead and complete, and then go ahead and enter the trade there at that point. So let's go ahead and talk about the whale trade strategy. This is the ES on a 240-minute time frame, and let's go ahead and talk about this one here on the right that we see here. So you have the volatility box being created. Right, you have another volatility box being created here, but we're not going to talk about this one quite yet. So we'll go ahead and just take this one off. All right. Now, once the volatility box is created, you will see a tick value inside here. All right. This says 232 ticks. If you can read it, this one actually says 191. You might be able to read this one a little bit better. So this gives you an idea right up off the top that how much you should plan to risk per trade here. So this is 232 ticks of risk that you're going to go ahead and place here. And again, it gives you that number right here on the box. Again, it takes a lot of the guesswork out of it. You don't have to measure it. You see it right away there on the box. All right. The next thing you'll notice is you have a high line here and a low line here. Okay, and it is identified a place where volatility has contracted. You can see the moving average throughout price here. This black line that's going through price. All right, that is the moving average that is calculating and filtering these trades with. Again, the volatility is contracted here, and right here is your signal bar. Okay, so this is where you want to go ahead and go long or go short. For a short, you can see this purple bar here. For a long, you actually see this blue bar over here. All right, so again, draws the box for you, gives you an idea of risk. Again, at this point, you're just going to wait for the breakout. You finally see the breakout there. Your entry is going to be at the close of this bar here. Your stop is going to be at the top of the box. And your target, again, built in, this is what these lines are for. This is target 1, excuse me. This is target 1, this is target 2, and let's see, this one is target 3. On the short side, you have target 1, you have target 2, and you have target 3. Now, typically, you want to go ahead and target 2. Target this one right here in the middle. That'd be target 2. You want to go ahead and target that one because there's a higher probability of this getting hit. And what I recommend is if you had multiple contracts, I'd either take a majority or half your position off here at 2 and then try to squeeze for 3. Now, as you can see in both cases here, we hit target 3 this one pretty quickly, pretty aggressively here. This one here, had a little bit of consolidation here as well, but then eventually hit it as well. But, target 3 could certainly be your runner. There's a good high probability of target 2 getting hit, as you'll see in all our examples here. All right, so there's your entry. Built-in target is here at 3. So we're short right here at the signal bar, and this one was good for 108 ticks. All right, so you profited here at 108 ticks. Now, if you took it all the way to the low, and you'll see this happen quite often, if you go ahead and let these trades run here a little bit, you would have captured 290 ticks off this move from here, all the way to this move down here. All right, let's talk about this one here on the left. So you have the volatility box. You're risking 191 ticks here in the box. All right, your entry is going to, you wait for the box to complete. You can see here, this is a good example of why you wait for the bar to go ahead and close. Now, you probably would have got a better entry here, but again, with high volatility and you're trying to time these breakouts here, you can get false breakouts. All right, so there is, a good reason why you want to go ahead and wait, but there's your entry here. Your stop is going to be at the bottom of the box. Now, your targets here, remember you have target 1, 2, and 3. Okay, and again, ideally you want to go ahead and target 2, but you can see 3 gets hit here as well. Now, your profits, there's your built-in target. Your profits in ticks to the target is 86, and if you brought it all the way to the high, you would have profited 117 ticks here. Now, this system works. There's a high probability of success with this system. It is right a lot more often than you'll get any type of fake outs here. So if you went to the target, 86 ticks here. Profits to the high though would have been 117 ticks. Let's go ahead and talk about another example here. This is in crude oil here on another 240-minute time frame. And this is something I really wanted to show you because you will get times like this, especially in a trending market, where you can actually combine 2 volatility boxes together. Now, you would have been in this trade for probably about 2 months, but this trade would have paid really, really well. So let's go and talk about this one. You have your box getting created here. It'll take about 262 ticks of risk here in the box. Your entry is going to be right there on the break of the low of that box here. Your stop is going to be right here at the top of the box. Your built-in target is going to be right here at 60.76. And the profit here to the target is 480 ticks. Now let's go ahead and talk about this box here. So you can see here the risk is looks like about 283. You got the volatility box here. And you have your entry actually right here. Now, from time to time, you will see another entry here. So if you have a purple candle here, you'll see another purple one here. That will happen from time to time, especially with strong breakouts like this. You may have a little bit of a consolidation. But either signal is fine. So if you miss this signal here, you could certainly go ahead and get short here. You have your stop right here at the top of the box. And you have your built-in target here. Now, as far as profit here, to the target here, about 352 ticks. Now, this is going to be like right about there. And if you actually held it to the absolute low, you would have been up about 378 ticks. Now again, if you combined both these trades like we were talking about here in the beginning, you would have been up close to 1,400 ticks here between both trades. If you went short here and then held it all the way through until you reach the final target down here, you're looking at a close to 1,400 ticks in profits. Again, you can see this trade was triggered at the end of October. This one was towards the end of October, about the midpoint of November here. So you would have been into this trade for about 2 months, but that's why these are the whale trades. You get monster trades here out of this, and they only get triggered about once a month. You can see here we had one on November 18th or 20th. This one looks like it was triggered, how this trade worked out. This one was triggered at the end of the month. So you actually had 2 within the month of November here. But typically you're just going to get that one. But you can see how many ticks you can squeeze out of these markets with the whale trade. All right, let's go ahead and talk about this trade. It's crude oil again on 240-minute time frame. So you can see the volatility box being created here. You have 164 ticks of risk here. Again, I think you know what we're looking for here to see the volatility box and the contraction. You have your signal bar here. All right, again, risking about 164 ticks. You can see that we got to this target here. Remember, this is the high probability target here. This is a great target here as well. Probabilities are in your favor here as well, but again, sometimes you have to wait a little bit longer for those. As far as asset allocation, you might be having capital tied up here for a little bit, so really up to you. We can see these do get tagged. This one actually got tagged when this box was starting to get created through here. Again, so this is kind of combining 2 trades here together. The first profit here, in terms of ticks, you're long through here, and if you held it and got out at the top of this box here, you're looking at a profit of 316 ticks. Now you see another signal being created here. Not exactly sure how this trade turned out, but again, this is one of those where you certainly could take profit, take some contracts off here at this point, and maybe let one run when you see another signal getting generated here. But typically, what you have here, the signal bar getting created, and if you get out right there at this target when the next volatility box is created, you have 316 ticks here of profit. All right, here's another example. Again, we're going to combine 2 trades here. So again, the volatility box is being created, and you're going to notice that, let's see, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, almost 11 bars here created in this volatility box, and only 1, 2, 3, 4 bars here. Now you'll see this from time to time where you have only 4 bars when you typically see 10 bars within contraction of volatility. Again, there's a lot of calculations going on in the background that you can't see. But again, you're seeing volatility actually contract here, even though we're seeing a little bit of a spike. You see 187 ticks of risk here, and then you go ahead and get long right about here. This closes this bar here, and your profit to this area here is 326 ticks. Now, you don't get that until you get to here. Okay, so now if you took this trade and then you waited for the market to contract, and then you went long here, cumulatively, if you took it all the way to the high, and again, you're getting long here, and you took it, and you see the kind of exhaustive top here, and it starts to reverse here. But if you took these trades together, you would have accumulated about 513 ticks of profit between both of these trades. So again, another way to kind of stack your trades together here. Get long on this one. You could take that profit here, or you can go ahead and let it run, because you got another signal here, and you would have gotten 513 ticks out of this trade. Now, as far as stop, and we can talk about this a little bit later as well, typically we want our stop to be down here in all these examples, but we do have traders that will go ahead and actually put it in the middle of the box. And there will be times where they will get spiked down and maybe get stopped out here, bottom tick, like you almost got one here. But if you put the stop here to tighten up your risk in the middle of the box instead of the bottom, again, you could tighten up your risk here and actually get even boost your risk reward by quite a bit here, and have minimal risk here, and then move your stop to break even, stair step it up, whatever you like to do. But again, we recommend putting it at the bottom of the box. We do have quite a few traders putting it in the middle of the box here. Wouldn't have gotten stopped out because the entry was here. Again, the middle of the box here wouldn't have got stopped out. Let's go and take a look at the previous trades here. Again, middle of the box here would have worked out here as well. Middle of the box here. Well, it might have worked out. Actually, I don't see the results of that one. Take a look at here. Let's see, middle of the box here. Got close here, but not quite. Again, you can put it here in the middle of the box. Again, reduce your risk. Never got stopped out here as well. Let's go ahead and go back a little bit more. Again, entries there. Stop here in the middle. Possibility wouldn't have gotten stopped out. Here's another way to go ahead and tighten up your stop. Again, right here in the middle. So you can see that over and over again, and it's certainly up to you. We have quite a few traders that go ahead and do that. Put the stop in the middle of the box instead of at the bottom here, but it's a personal preference. Here's another example here in the NQ. We're going to go ahead and start running through these a little bit quicker. Again, you have risk here, 1,035 ticks. Your entry is going to be here. All right, stop could be either here or at the bottom of the box. All right. And then this one is actually, you can combine two of those trades together. You have profit of 248 ticks. This is going to be to the second area here. And you would have tagged that in this second day here. Or this second trade here, I should say. And if you put these together, again, cumulative profit of 336 ticks here in the NQ. Okay, here's the NQ again. Again, we have our stop again, either here or at the midpoint of the box here. Entry is going to be here. All right, and again, we're targeting, again, the high probability area here. That would have been 180 ticks of profit there. And let's go ahead, and this is actually a really good example because you see it to the downside here. Again, the high probability target is hit. Let's go and take a look on the upside here. We have 402 ticks. Here's your entry here. Again, stop is either going to be at the low or at the midpoint of the box. And we're long through here, and you can see how this squeezed right into our third target there at 402 ticks. All right, so nice combination here, almost 600 ticks between the two trades. Here's a YM. Again, you have the volatility box here, and your signal is here. And again, you could put your stop here in the middle of the box or the bottom. You can see, again, wouldn't have been stopped out. And it squeezes to your second profit target here, which would have been 564 ticks. Now, if you combined it, you have another trade here. Again, got to the second area here again. Cumulatively, you would have had 809 ticks if you combine both these trades here on the YM. And what's cool about this trade here is that you actually had two volatility boxes at the beginning of January, and this is in the middle of January. So you actually had two trades out of this market for this month. Another great example here in the 6E. So we're going to transition now to something a little bit different. This is a 60-minute chart of the 6E, and I'll show you this when you get into the tool, but you can actually adjust the setting here. You could get more signals out of this as well, but wanted to show you this is a 60-minute chart, and again, we kind of adjusted the settings here just a little bit here, and you will sometimes see something like this where you get a signal to the upside and then a signal to the downside here. All right, so on this one, if you had to stop here in the middle, again, you would have been stopped out, but once you start to see this start to pick up momentum and we break it in the same day, you want to go ahead and go in the direction. So you get chopped up here a little bit, probably lose on this trade here, but this trade works out really, really well. You make your profit and then some. So this one we do profit about 82 ticks here, but not a huge mover. But again, this is a 60-minute chart. We tweaked it just a little bit. I'll show you how to do that here. But again, sometimes you will get signals like this, but this is a really nice trade, 82 ticks all the way down here to the low. Crude oil, again, in 60-minute time frame. This is another tweak to it, so you can't put it on shorter time frames. Now, you will be able to get more signals out of this, but you know, they may not go for. They might be a little bit tighter markets. They won't go for as much as you will see, you know, 300, 400, 500 tick trades. You'll see a little bit less. Every once in a while, though, you will be able to get a trade that is triggering earlier on a 60-minute and you see it trigger later on a 240-minute. So that's a possibility as well. But again, crude oil 60-minute time frame, and you can see the signal being generated here. Again, stop is either here in the middle of the box or the bottom. And we went all the way to the top to the third target here, and we would have profited 174 ticks on this. Again, using a 60-minute time frame, and we're going to boost that volatility strength by 2, and I'll show you how to do that. Here's another example. Again, this is a great trade here on a 60-minute time frame. Now, this is a good example is that if you did have your stop here in the middle of the box, you would have gotten stopped out after that entry bar. I could have re-entered on these bars here if you wanted to. But again, good example, if you put it in the middle of the box, you would have got stopped out there, so we recommend putting it down here. You can see the signal there, and we hit that third target and went well through it here as well. 133 ticks, but if you went all the way to the top here, cumulative profit would have been 329 ticks in this trade. Again, another example here. So we start here, again, tight market. This was a monster trade on the 60-minute time frame here, but you got your signal here. Stop could have easily been here in the middle of the box or at the bottom. And to the target here, we're talking 123 ticks. But if you were able to ride this trend out, you would have accumulated 550 ticks off this whale trade here in crude oil based off this 60-minute signal. All right, so we talked about the whale trade system. You saw all those examples. Let's actually go ahead and transition to the chart here, and I'll show you exactly how to set that up. So I'm going to go ahead and go to a crude oil here, 240-minute time frame. I'm going to go ahead and load the tool on here. All right, whale trade there. Go ahead and load that on there. Make sure you put your order ID that's specific to you up here at the top. I'm just going to go ahead and hit OK and go ahead and load it up here. And you can see right away, it loads the tool right on here, and you're all set and ready to go. All right, you can see a nice whale trade here. Again, you actually see a couple here. This one was good for, went to the high there, for about 476. Sometimes we'll see a little bit of chop like this, but you can see this long trade still working. Needs maybe a little bit more time here. Beautiful short trade here as well. All right, and then you can go ahead and go through this another nice little short trade here. Sometimes you will get a little chop like this. Okay, so you see if you're long here, it doesn't really pan out. Maybe if you have your stop here, otherwise you can, if you're not really getting that move to the upside, go ahead and try and cover these things a little bit early if you're not really getting that big thrust to the upside. Typically, you want to see these work and work fast. All right, just like you see this one work and it works fast. This one's the same way. Kind of pull back a little bit here, but that worked out pretty good. You get a lot of chop in here. When you see that choppy markets, they're not really moving in your intended direction. You might want to cover that if you sometimes just get bored of a trade. This is a nice one here because you had a whale trade here, another whale trade to the downside. You can marry all these things together, and we just talked about this last one here, but you can see if you combine all these things together, all these trades together, you would have had a pretty monster trade. That's like 1,700 ticks there. Here's another one. You can combine together here. One trade to another. All right, you're talking 583 ticks there. All right, so let's go and talk about some of the setups, and I'll talk to you about the tweak that we showed on the 60-minute time frame as well. So here's the alerts here. So order ID, again, that's specific to you. Consolidation start. So if you want an audible alert when this box starts to print, you can go ahead and put the alert in there. You can have a high break and a low break. So once the price breaks above the box or below the box, you can go ahead and get an audible alert there. Just go ahead and select whichever alert that you like. Now, multi-alert. So if it comes back into the box and then tries to break out here again, you can put multi-alert here. Go ahead and check that. So again, something like this, you'd get an alert on this break here. But if it comes back down and it breaks again, you'll get another alert for this one, if you have that checked off. Now, volatility strength is set to 20. Now, this is a good setting. Typically, we recommend 240-minute with a volatility strength of 20. But if I'll just show this to you real quick. Let's go ahead and go to a 60-minute time frame. And I want to show you, go ahead and put this to a 40 strength. All right, so the parameters are going to be a little bit stricter. So you see we have the 240. We saw a lot more boxes, but now since we boosted the strength, it's going to be a lot more strict. So a lot of those boxes went away. And this is pretty freaky accurate. It's pretty good here. But you can see here we had a beautiful box here, and this definitely hit its third target here. Again, 167 ticks. Here's another beautiful trade. I think we talked about this one here. That was a really nice trade here. And here. This actually did work out eventually, but you had a little bit of chop there. Here's another example of this trade working out here. This is a really nice one, again on the 60-minute time frame. Just turns out to be some monster trade here. Now we transition here to the YM. Just showing you this one here. I actually got current one. So it looks like it's trying to set up here. But you can see another, again, the 60-minute time frame, again, of that 40 volatility strength set to 40. You can see a nice couple trades here actually worked out really well. Right before it reversed, but it hit those targets. Another great example here. So you can see that the target or the trade was triggered here. But again, another nice monster trade here in the YM. And here's another one here. Again, trade triggers here. Went well past that third target, actually gapped up above that there. Again, another one here. Really nice trade here. You can see this is this works out really well. And in a couple other short trades here as well. Just monster trades that come out of the 60-minute time frame here. Just to that low, we're talking 1,500 ticks alone. So let's go ahead and get back into the tool setup and talk about some of the other settings here. So let's go ahead and go back to the default here, because this is a tweak that you can go ahead and do. And let's go ahead and go back to this one. And let's go ahead and put that at 20 again. By default, this tool works out really well. You can see the signals at here in the YM that it generates. Get a nice short there, a nice long here. A few longs there actually worked out really well. All right, so these are the default settings. Let's go and go down to these other settings here. Email address and email subject. So if you want to be emailed when these alerts get generated, you have to populate and put your email in here in both of these boxes here. So bars look back for the global settings here. So what this will do is this box can get up to about 30 bars wide here. So it's always going to be looking back about 30 bars here to identify the right volatility conditions. You want to leave that there. Now show boxes, show lines, moving average, all these things. If you want to take any of these off, you can go ahead and just hit the check box there. So if you want to take the boxes off, you can do that there as well. I'll show you something else here. You can have a button up here at the top. If you click on that, you can hide the boxes, you can hide the targets, and do whatever else you'd like to do here. So that's all built into this button up here. You don't actually have to go into the tool to go ahead and change those settings. All right, so that's all there. Settings, extend high visible. So what this will do, I'll show you this here. So you notice that there was a line up here at the break. Now that line has gone away. So if you want those lines on there, make sure by default you go ahead and just leave them. If you want to take them off, you can go ahead and do that there as well. Now these lines will extend for 20 bars, and then they'll stop. If you want them to extend for 40, let's just say, it's going to double the length, you'll notice those bars will go out further. So that's really up to you. That there. And that's the same for low visible. So if you extend, go put that to 20. If you go ahead and extend, you can extend one or the other, and the line length will be set to 20. Extend middle visible. So if you want the middle of the box to go ahead and place your stop, you can certainly go ahead and do that there. A lot of traders will like to do that because it kind of tightens up their stops. And you can see when these trades work, they work pretty quickly and pretty well, and they'll go ahead and put their stops there. Typically, again, we recommend the bottom of the box, but you can start out with the bottom of the box and quickly move it to the middle of the box if it's working, and then maybe move to break even. Up to you. But if you want that middle line, you could certainly put that there as well. The extended target 1, we have target 2 and target 3. These are these lines here. Okay, so these lines are set to 50%. So this first target is 50% of the box, and is set here as a target. This target 2 is the full width of this box. So this is 100. So I'll just go ahead and show this to you here. So this box is 402 ticks wide, and from the top of the box until the second target should be right. Yep, right about. This says 388. Well, I'm probably off just by a couple ticks here. Yeah, so about 410. So this is 100% of this box here. So these are just these raw calculations put in here. The target is 200% away. So it's 200% the size of this box here. So it's twice the size of this box. Now you can go ahead and adjust these. So if you want this closer to 150, target 3, you can see how it tightens up there. And again, a higher probability that's going to get hit. But if you want a good runner, 200 works okay. All right, so it's twice the size of this box here, and that would be your target. If you want that target 3 off, you can go ahead and just click that and take it off here as well, or you can leave those lines on. All right, the font size is set to 9, but if you want the font size of these numbers or anything else to go ahead and change, you can go ahead and adjust it there. Put that back to 9. The cross boxes only, go ahead and leave that checked as the bar crosses those boxes. You want to go ahead and paint those bars. You want to make sure that's checked. Moving average period, now set to 5. So this is where you can change your moving average type. It's set to an EMA. We have SMA here. You have all these different types of moving averages. You can go ahead and adjust those. And you can adjust the time period as well. So these moving averages are a filter for the tool, so to make sure that you're trading in the correct direction here. So we recommend leaving it to 5. But again, if you want to change that to a different setting, that's really up to you. Now, the standard deviation width and the ATR strength, these are also calculations that help calculate this volatility box. If you want to go ahead and change those, you can certainly do that. We recommend not touching these and leaving these the same because the calculation, again, is very finely tuned and is very specific to the whale trade. But if you want to kind of tighten these up here, as far as standard deviation width and the ATR, you can go ahead and adjust these signals here. Input series and setup, you want to leave all of these here the same. Visual, the box area brush. Now this is for the box. It's going to be orange here. If you want to change the color of that, you can go ahead and do that there. The opacity is set to 30, so you can see the bars going on behind it. The outline of the box is gray. You can change the color of that. It's all cosmetic stuff here. Extended area high, that's going to be this line here. Targets are going to be gray. Extended low is going to be red. Extended middle, it's going to be that middle line there. It's going to be gray as well. Now, if you want to change the color of the bar, so once it breaks the high, it'll be blue. This cornflower blue. Once it breaks the low here, it will be a magenta. The moving average line is set to black. Tick height position, and that is, if you can see it, you see this one actually here on the left of this box here, 640. So if you want to change the font of that, the color, or the height, you can go ahead and do that there. Everything else down here, you want to go ahead and leave the same. Go ahead and hit OK when you're all done, and you're all set and ready to go. This is the default setting. Again, 240-minute time frame with the volatility strength set to 20. But you can see another good trade there. You can set these to different settings in the 60-minute time frame, but you can see this one actually works out really, really well here. There's actually a loser here. Got to show you those with the good with the bad. But more often than not, you have pretty good winners here and pretty good just monster trades here using the whale trade strategy. So go ahead and put the whale trade strategy to the test, and good hunting out there and happy trading.